G'day guys, Andrew Baxter here, and in this week's blog it would be crazy not to acknowledge the RBA's decision this week to adjust interest rates here in Australia. So the official cash rate now is sitting at 1.5% in terms of the cash rate. And the actual interest rate cut was a 25 basis points or quarter of a percentage cut in interest rates. The question is why? And if the economy is as strong as people say, reducing interest rates is a way of fueling the economy, putting more gas in the tank and lifting things up. You don't tend to cut interest rates when the economy is pumping really hard. The other issue that we have on the one side, as I say, so we'll talk about growth of the economy over here, and we're going to talk about the other side, which is inflation over here. Now, our inflation rate has been consistently above 2.5% for a period of time. And that's fine if it's at that level, but if inflation starts to move up higher, which happens in an expanding economy, interest rates should be moving up. So clearly there is no inflation threat in the economy right now. One area, of course, where there is a pressure to the upside is house pricing. And house pricing has been one of the stalwarts of economic growth in Australia. If you look at the mining boom as one thing and then the move up in house prices as being something else, these have been two of the big catalysts for the wealth effect in Australia. But growth is fairly flat. In fact, for anybody out there that's in business, you probably noticed that it's just a little bit tough. Certainly that run up to the election was very, very slow, and things haven't recovered that much since. Now, of course, the RBA's decision to reduce interest rates is a way of stimulating economic activity because people are less inclined to save, not that we need any encouragement in Australia not to save, but secondly, to get out and spend that money. That's what pumps up economic activity. It also means that mortgages are more affordable, so it's providing a support underneath house pricing. Now, house pricing, while it's been one of the driving forces in the Australian economy, is also one of the hot buttons in terms of risk. Now, when we talk about property, and I'm also a property investor, not just stock market, some of the areas of property, and we've got to split up into many segments, there isn't a property bubble in certain areas, but there is in others. So if we look at, for example, in mining towns where, not so long back, maybe a year or 2 years ago, in Port Hedland, you might have been spending $1.3 million to buy a five-row shack, which is now worth about 450 grand. That's an example of an extreme bubble driven by the mining boom and just driven by huge speculative money washing into markets. But if you look at real cities, the big core cities, Sydney, Melbourne, Brisbane, and particularly Brisbane, which has been quite strong, those cities have got an economy, they've got a pulse, they're not based on just a mine. And so the support in those property markets has been very strong. A reduction in interest rates will go a long way to supporting house pricing. Now, the banks, generous as they are, haven't passed all of that interest rate cut on, they've kept a little bit back. And part of the reason that they're siding for keeping that money back is that they are finding it more expensive in wholesale money markets to get money to then on lend. And secondly, with interest rates at 1.5%, there's not really much fat in the game, so margins have been squeezed a little bit. And we know that banks need to preserve their valuations in order to continue to be able to pay out the dividends that they do into the superannuation industry. So I suspect that while we've seen a cut and it's not being passed on this time to the consumer, the RBA are likely to be, and APRA are going to be likely not too motivated to push the banks too hard to pass that full cut on. So what can we deduce from this decision to cut interest rates? Well, some of the dangers when interest rates get too low is that you can run into an environment where the economy really does start to stagnate. We've seen in the US interest rates are practically zero. We've seen in Japan they're effectively minus. So those very, very historically low thin interest rates can be a big alarm bell. If you're debt-free, well, the ability to be debt-free and invest means that if this is the benchmark, you're not saving anything on your mortgage, that's for sure. But this lower level of return effectively puts us into a lower return environment. Now, a lower return environment means that as an investor, you've got to seek out alternatives to get a higher return. My father lives in the UK, he's retired, he likes fixed interest because of the security that it offers and the regular income. The only problem is when interest rates are at this kind of level, the return on fixed interest is paper thin. It's an income, but it's not the income it could or should be. As a result, investments in lower yielding products like cash or a fixed interest product become less appealing, and people have got to seek other opportunities outside of that. And my take on this would be that from a stock market perspective, we are going to be into a slow growth environment. Slow growth environment. Which means as a traditional stock market investor, returns may be below what their historical averages have been. Why? Well, returns across all asset classes are going to be lower. But what that also does is create an opportunity. And it's very, very important when you look at these things, not to paint a black picture, but to look for where the opportunity sits within this scenario. And in my opinion, and in terms of the way that we're structuring our investment portfolio, this is a ripe environment for covered calls, because that ability to generate over and above in terms of income, so instead of 1.5% per year, 1.5% per month becomes a realistic probability. Now, of course, you're not going to do that every month, but that is an environment that this strategy should thrive in. Now, for some people, it's a strategy they're not familiar with. They might be a share investor, in which case, if they are a share investor, they only make money when markets go up. A covered call investor makes money when the markets go up or when the market goes sideways. And if you're looking to have more options, no pun intended, and the potential for a higher level of return, the scenario I've drawn out here, based on pure economics, I'm an economist by qualification, but based on pure economics would suggest that lower return environment means that we've got to look outside of those traditional investments. Cash-based products, fixed interest, no good. Probably market may stabilize. But if you're looking for regular and over the odds income, this is the strategy that you should be using. Interesting decision, and it doesn't leave much more room to the downside. But the RBA have been quite cagey in terms of the way that they've played their hand both through the GFC and subsequently, so they do have some room to move. Now, whether that move comes down a little further will be interesting to see. But all the while, as interest rates move down, it creates more interest in this strategy. And if you're going to use this strategy, better sooner rather than later, so you can master it and be generating the cash flow that you truly deserve before everybody else gets to the party. Covered calls, great strategy, great place to be, and with the current environmental background economically, probably one that fits better than most. Hope you found that useful. If you need help on this, click on the links below, and we'd love to train you, teach you, coach you, mentor you, and how you can be getting the most out of the covered call strategy.